Well, good morning, everybody, and welcome to the press conference at the Reserve Bank for our May Financial Stability Report. In this report, we note that New Zealand's financial system is now looking more resilient and positioned to support economic growth for the future, but we still face a volatile and uncertain environment. The global economic recovery is now looking more broader-based, and strong Asian growth has been supporting commodity producers like Australia and New Zealand. But we do also note in this report that the global wholesale funding markets remain quite fragile, and that's given the stretched fiscal positions and some banking sector problems that we continue to observe in some European countries. In New Zealand, households and business are still aiming to cut or contain debt, and this is reducing our overall external imbalance, but of course it also weakens domestic demand pressures. In addition, the New Zealand government is looking to consolidate its financial position, and this additionally helps reduce New Zealand's overall external imbalances. The Christchurch earthquake figures in this report. The February earthquake has caused very significant financial stress for households and businesses in Christchurch, and it's also presented challenges for the insurance sector, which has to deal with the claims flows, and we comment about that in the report. But banks' readiness to support recovery in Christchurch looks encouraging to us. The Christchurch rebuilding is going to add significant momentum to the economy, and that's going to continue to require access to credit despite the high levels of insurance payouts that we expect to see happening soon. Ladies and gentlemen, can I hand over to Grant Spence, Deputy Governor, to continue?
In our view, the New Zealand banking system has continued to strengthen. Bank profits have recovered over the past 6 months, and bad debt charges have declined. The bank's funding has moved to a more stable footing, and they look pretty well capitalised. On the regulatory front, the bank is currently evaluating the new Basel III standards for capital adequacy, and we expect to consult on this later this year. More immediately, we're looking to restore more appropriate risk weights on rural lending from June, and to increase the core funding ratio from 65% to 70% this July the 1st. These moves have been very well signalled and largely anticipated by the banks. Another thing we are consulting on is the pre-positioning of banks' internal systems to enable open bank resolution, or OBR. This is a process that would allow a failing bank to be kept open by rapidly allocating losses across shareholders, depositors and other creditors. Having this sort of policy option in the toolkit should reduce the pressure on government to adopt taxpayer-funded solutions when dealing with a distressed bank. Turning to insurance, as you know, the Reserve Bank has recently become the regulator of this sector. Following the recent earthquakes, the government has had to support AMI, a major insurer of Christchurch residential property. This was necessary to ensure an orderly claims process and rebuilding in Christchurch. The bank has accelerated its insurance work program in light of the earthquakes and is monitoring the sector closely. While there remains considerable uncertainty around the extent of total final claims, we do believe that the overall industry is sound. Thanks.
Thanks, ladies and gentlemen. We're open for any questions you might have.
You say the overall insurance industry remains sound. Are there any particular entities that you have fears about?
I'd say that We continue to monitor the industry quite closely. The level of claims isn't clear yet. It's possible that it could put stress on solvency on a couple of specialist insurers, but we'd expect that wouldn't cause particular problems for their parents. So it's more likely parental support that you'd be looking at.
You mentioned that there might be some consolidation and exits in the insurance industry, with some of them not meeting the licensing requirements. So I'm just kind of curious as to where some of those shortcomings might be.
Well, it's there are a lot of players in the industry, some large, some small. There hasn't been a regulatory framework as yet. So when we introduce the new standards, most of the large companies, most of the industry are already meeting those sorts of standards, but there will be particularly some of the smaller players, who may not be able to stack up. That still remains to be seen. We don't set the standards won't be finally set till mid-year, and the applications won't be until mid-year, so this is all still hypothetical, but it's possible there may be some shakeout, some consolidation.
On the insurance companies, have you undertaken any work to look at upgrading those requirements for insurers, given that we're told that AMI most probably met those requirements?
Well, we've had an initial round with our solvency standards. We got feedback from that. That was prior to the earthquake. Subsequently, after the earthquake, we've gone out with a further standard. We've made some adjustments, but we're certainly interested in the view of the industry of those standards in relation to the experience that they've had with the earthquake. So I think it's fair to say the earthquake will have some impact on the overall regime, and obviously we're looking to learn lessons from that. I'd say generally the two lessons probably are, that we need to take a pretty conservative approach in light of what's happened. Also, I think it's the importance of risk diversification has been highlighted considerably by the earthquake experience. Diversification of risk within the companies.
So that would be a tightening of those requirements then?
Not necessarily. The solvency standard we've gone out with in the second round is pitched at a very similar level to what it was in the first round. There's sort of qualitative changes, but we've already been taking a conservative approach. I think if you ask anyone in the industry, they'll say the Reserve Bank is being pretty conservative in the solvency standards that it's setting.
You say you're monitoring the loan-to-value ratios being offered by the banks at the moment. Are you worried perhaps of a return to the lending boom that was seen in the 2000s? And if not, what's different this time?
What's different this time is that there's a concerted effort by householders to be cautious to reduce debt. There's signs that the housing market has bottomed out and is showing the start of a bit of growth, but we're really not seeing the preconditions for any big sort of rise in house prices or big rise in debt exposure.
Is it irresponsible by the banks to be offering such high loan-to-value ratios again?
Oh, not necessarily. I mean, you've got to look at where they're doing it, under what conditions they're doing it. As I understand it, that's a pretty limited extent at the minute. It's something that we will continue to watch pretty closely, and we wouldn't hold back going and telling the banks our views if we thought that was getting too exposed, but I don't think it's like that at the moment.
Is it your view that AMI will be able to avoid taking up the government facility?
We can't really comment on that, Barry. That's a matter for the Crown, for the Minister of Finance, who have taken over responsibility for that potential support.
What impact do you think a credit rating downgrade for New Zealand and or for the banks might have on the financial system and borrowing costs?
I'd note there's two different things here. One is sovereign, of course, sovereign credit rating risk, and the other is bank credit rating risk. On the bank side, you'll be aware that already out in the marketplace for some time with both Australian and New Zealand banks, one of the credit rating agencies has talked about doing methodological changes which could have an impact of reducing credit ratings. The approximate work that we've done on this suggests that the market pricing already could reflect that in, and therefore it wouldn't necessarily have a significant effect. But having said that, one wouldn't really want to see it happen, particularly if it was unnecessary, particularly after the banks had come through the global financial crisis in pretty good shape, particularly if it looked like the credit rating agencies were an ultimate lagging indicator on the crisis, the last thing in the market to move. Actually, as you know, one of the credit rating agencies is also recalibrating sovereign risk, and that's not just New Zealand, it's basically across the whole range of their ratings. And already they've said on that basis that there's potential for a number of countries to face potential for downgrade. New Zealand could be one of those. Again, that's just a recalibration, and frankly, if that happens, there's not a lot that New Zealand can do about that. That's saying that they're looking at different criteria in different ways. But we are on negative outlook for government debt for one of the rating agencies, and that's something we would want to avoid if we possibly can.
What would be the effect of a downgrade?
On government? Do you want to answer that?
Well, I mean, negative outlook's already there. I mean, there may be some impact on market pricing, but at present there's very strong demand for New Zealand government debt, actually, in the international marketplace. On the bank side of things, I think, as Alan said, there's effectively a one-notch downgrade already implicit in the pricing of bank debt. So I'd be surprised if that moved. If there was an actual downgrade of the banks.
You seem to welcome the government's intention to cut government spending, the budget spending. Is there a danger that it cuts too much away?
Well, what we've said is actually that we welcome government talk about the likelihood of them in the budget consolidating the fiscal position. So we wouldn't particularly point to revenue or expenditure, but it's that net fiscal effect. And yes, that is important in an area where there is now much more focus internationally on country fiscal positions. New Zealand fiscal position looks good, but it has been worsened as a result of the Christchurch earthquake, and we've got to show a path back to recovery on that because the government is in the market for funding.
And do you think 2015-16 is a reasonable year to be returning to
well, we haven't made a particular judgment about that. We're looking for a track for fiscal recovery and consolidation.
Do you think there's a risk that a fiscal tightening will come too strongly and too soon at this stage of the cycle, though?
Well, we see the macroeconomy picking up, so we see private sector pressure for growth overall, and as you know, Brian, fiscal responses can take quite a time to have an effect, so it's pretty rare to see a fiscal response happening too quickly. It can tend to happen too late and be lagged on those cycles. So in answer to your question, no, we're not worried about that.
Can you give some comment on the housing market? There's been signs of pick-up in the Auckland market, but you seem to be downplaying that here. Do you see the possibility for further house price falls?
Look, we observe, for example, the IMF's various models that suggest continuing equilibrium house price overvaluation in New Zealand. There's a number of bits of work in that area, but no, looking at where the cycle is in housing at the minute, we think it's bottomed out, and as gradually strengthening. We don't put too much stress on month-by-month data in one particular region, but what we've been seeing in Auckland is broadly symptomatic of the sort of gradual recovery we're expecting to see across the country, part of which is made more uncertain and more unclear, of course, by the Christchurch situation.
You mentioned in the report that bank profit margins, particularly on lending, are stronger in the last year or two. Do you think it's appropriate for them to pass that on to customers in relatively lower lending rates and higher deposit rates, or would you be relaxed about what they've just done?
Well, I think we're pretty relaxed about where margins have gone. I think net interest margins of the banks were trending down through most of the crisis and recession period, and now they're recovering a bit, particularly with the shift from fixed rate mortgages back to floating rate. The cost they've been paying for deposits has been quite a negative impact on net interest margins. So I think they're recovering to levels that are pretty normal by historical standards.
So you think they're paying quite well for term deposits at the moment?
They are, yes. So, substantially more than they used to pay pre-crisis. And that seems to be an ongoing thing where now the banks and anyone else bidding for deposits is having to pay, pretty attractive rates.
And that's due to your changes in the capital ratio requirements?
Well, it's partly due to that, but it's partly just due to the bank's desire to bolster their funding and to increase their what we call core funding, which is like retail funding and long-term wholesale funding. And this is, for example, we're observing that in Australia as well, even though they don't have a core funding ratio. So it's something where the banks, they'd be particularly urged to do this by the rating agencies as well, to bolster their retail funding.
You mentioned in here the relative strength of the New Zealand dollar on a trade-weighted basis, and I wondered if it's getting to a point where you might consider looking at intervening. And also, do you concur with the IMF's comments yesterday that the Kiwi is overvalued by as much as 20%?
Well, as you know, we never comment about conditions for intervention, but we'd continue to say what we've said before, which is that New Zealand dollar is high against most of its trading partners, but of course very low against the Australian dollar, which opens up very interesting export opportunities. And to a large extent, that's been supported by the very high commodity prices that we've been getting. So despite that, we do feel that the New Zealand dollar has continued its record of being surprisingly strong for some time. We don't have a particular percentage view on that.
Can you just clarify in a recent speech in Ashburton you talked about, seemed to express some comfort about a high New Zealand dollar when so long as commodity prices remained high, but in the most recent OCR statement you said you expressed some discomfort with the level of the dollar. Does that represent a change of view, or
no.
Can you...
No, and I didn't express particular comfort in the Ashburton speech either. We said basically that we could understand some of the drivers for the increases in the exchange rate. Certainly didn't reflect a change of view about that. We think that it would be better for the New Zealand economy if the New Zealand dollar was not so high.
Could you talk about the potential risks of a meltdown on the European financial markets and what that might mean for us?
Well, we're not expecting a financial meltdown on the European markets. I think the European markets around the pigs issue has clarified itself to say there are 3 countries of Syria where the fiscal situation is a serious concern, and those are Greece, Ireland and Portugal, and the market pricing suggests that there's a real focus on those three now and not on some of the other ones. But the Europeans have been pretty clear about their support. It's really just a question of how that plays out. But of course it does mean that those sovereign funding markets are being more careful, looking more closely, and they're always ready to judge other countries on a similar basis as well. And that's one of the reasons why it's always important that we keep our fiscal position in a good shape and continuing to be in a good shape.
But the IMF says that still about half of our GDP is rolling over every less than 90 days. Do you think that the banks have reduced their exposure to those hot money markets enough?
Well, if you're talking about bank funding with our core funding ratio, as you can see in one of the graphs in this financial stability report, we've had longer term funding. It's meeting our requirements. We expect that to go a little further. We're pretty pleased with how that's going. That has been one of the learnings for Australia and New Zealand out of the crisis, and we're pretty pleased with the response. So we don't have particular concerns. We are seeing changes in bank funding practice there, though. They are funding longer and more domestically.
Are you concerned that the changes in rural capital requirements announced today might make it more expensive and difficult for farmers to get loans?
No, we need to be clear about this. We haven't just announced them today. We announced them last year and the year before, and actually we announced them before some of the current chief executives of some of the banks have been objecting to them. Actually, we're in their position in New Zealand. So there's nothing sudden about this, and this reflects another learning, which is that late on, before the crisis, after some of the subprime stuff was already showing itself, because dairy prices remained high, banks went on a big lending push into the dairying sector to a level that could have been worrying if dairy prices not picked up again. Now that's a learning. We want to take that on board for the New Zealand economy. It's a vulnerability. We don't want to see that happening again in the future like that. And that's why we have been talking very carefully over a long time period with the banks about this, and why, subject to final consultation, we expect this risk weighting to be put in place. There should be no surprise for the banking sector. There should be no surprise for farmers, including those who potentially got themselves overexposed in the last, just before the crisis. Memory should last a little bit longer than that. So we want to see proper risks properly reflected there. Sorry, did I sound overexcited about that one?
Given that the farmers seem to have taken aboard that risk, and we're seeing really depressed levels of farm sales even with high export prices and low interest rates and so on, is there a concern that this terms of trade boost, that seems to be a large part of the recovery story, that a lot of that income growth will be sort of soaked up by debt repayment and not flow down to the rest of us? I mean, how would you tell how that's playing out?
Yeah, I mean, that has been happening. It's wise that farmers have been using those very good commodity prices to reduce debt. We think we see some signs of them starting to spend some more now, having done their initial debt reduction, but some of that will continue. As they start to spend more initially on farm inputs, that starts to trickle through the economy more. But if we do continue to see very strong commodity prices, then that is going to impact through on New Zealand's rural sector directly and only indirectly on other parts of the sector in New Zealand. And it's possible that we might have the same sort of debate that Australia's been having about how you recycle, in their case, mineral profits around the broader economy.
You talk in the statement about conversations with the banks over the open bank resolution process. How are those conversations going? And have the banks welcomed this? What's their view?
I would say that the banks generally see the logic of it and think it's pretty sensible. I think their main concern is that they have plenty of time to put these system changes in place, because they have a program of system changes, and it's not something they can do quickly. I mean, the other issue that they've mentioned and raised is the potential impact on ratings. We think that's relatively marginal. It has been mentioned by one of the rating agencies, because they assess potential implicit parent and government support, but they have to make the call on that at some point. And as I say, the key issues we were talking about before in terms of looking at the ratings of the banks are more around the broader macro external debt issues, and I think the OBR is relatively marginal on that front.
Are you reasonably happy with the state of the non-bank sector? I mean, and I guess I'm just trying to get a sense as to where you see the future for mezzanine lenders, if there is one, since we've got most of the bad ones out and seems to have contracted a fair amount.
Yeah, well, the non-bank sector has consolidated, as we know. It's now much smaller. It's gone back to its roots in terms of the activities it's involved in, a more traditional sort of asset-backed financing type activities. And yeah, the mezzanine type financing, I think people have realised that it wasn't an appropriate place for that to be occurring, based on debenture financing that's essentially equity financing, and so that the future vehicles for funding of property development, etc., will be of a different nature and will be of more of an equity type. And there are funds, equity type funds, that are now developing and to channel equity type funding into property development sector. But as you know, that sector is still pretty slow, hasn't picked up to any great extent. But when it does, I don't think it'll be the finance company sector that'll be involved.
Sorry, just going back to your comments a couple of minutes ago, Dr. Bollard, about spreading the profits from the high terms of trade through the economy. What do you say to the view that that's actually happening by way of the high exchange rate, basically keeping it high and lowering cost of imports?
Well, fair point. To some extent, that's true. Of course, other parts of the exporting sector do suffer from that. So if you're in manufacturing and you have to price in US dollars, then it's much tougher. But from producers to consumers, I think that's absolutely true.
Do you have any thoughts on when the deleveraging in the household sector might stop? Where is a normal or natural level for it to bottom out, or does it just go back to 100% like it was 5-6 years ago, or do we bottom out here?
Well, we're all learning about that, and I mean that's a very important point for our economic forecasts. Less so from our financial stability point of view. We're reasonably comfortable about where that's going, but we can only observe how much New Zealanders are changing their behaviour as a result of the crisis, and how much they intend to change that behaviour long term rather than transitionally. So we think there's probably some changes in behaviour. We don't think they're looking at household budgets in a completely different way, though.
There is a risk, if it continues, of a balance sheet recession for the New Zealand economy.
Would you like to elaborate?
So in Japan, after their bubble burst, there was some falling in asset prices, and eventually people stopped spending, continue to stop spending, and there is a risk here. If New Zealanders keep deleveraging, you just won't see the domestic economy fire up again.
Yeah, that's not a risk that keeps us awake at night. I think if you're looking at other candidates to join Japanese housewives, New Zealanders would be pretty low on the list.
How are you going with looking at the supplementary tools, such as being able to control loan-to-value ratios and those kind of tools that you spoke about a few months ago?
Well, we've now established quite a bit more information about what other countries are doing, what we could do, and what, if we look back into the recent past, how the extent to which any of those tools might have helped us in the lead up to the global financial crisis. You can see information on those in some detail with some of the pieces of work that the bank has published. Bernard Hodgetts here has co-authored a number of pieces on that. Some of those are on our website. But in general, what that says is we think there are some tools that under very specific circumstances could be helpful in assisting macro financial stability through the cycle. We do observe quite a lot of interest and some excitement around the world on these, and some of that is going to be disappointed because some of it we think is unrealistic. We're trying to be very realistic about this. We think some of them do look helpful. Could they help monetary policy as well? Well, only indirectly, but possibly in the same direction. So perhaps to be a bit more specific, were we to see a build-up of asset prices or property prices in a way that looked like it was leading back into the last sort of bubble boom, then we would certainly look at some of these things, such as core funding ratios, but we are not, we don't have huge expectations about those as silver bullets.
And which ones do you view as unrealistic?
Oh, well, actually, if you look at this particular paper that I'm suggesting, you'll see we look at 4 classes of tools, and they all have their day under certain circumstances. They include core funding ratios, counter-cyclical credit, Bernard...
capital.
Adjustments
Sorry, can we just put Bernard into the mic?
So in the 4 tools we've looked at are counter-cyclical capital buffers, which is one of the suggestions under the Basel III proposals, adjustments to core funding ratios, adjustments to some maximum loan-to-value ratios for residential lending, and the fourth one was the adjustments to sectoral risk weights for particular sectors. If you were finding that a particular sector's growth rate for credit was excessive.
Just to go back to the capital adequacy requirements for farm lending, I just wondered what the minimal capital requirements will be under this now.
Well, we're still working under the Basel II regime effectively, where, say, minimum Tier 1 ratio is 4%, but effectively the banks are now really working more in line with the new Basel III proposals. So Tier 1 ratios are up around sort of 8 to 9%, which is in line with the new requirements. Now, the rural capital, it's really the requirements we're talking about are around the risk weights that they put on agricultural lending, and the technical sort of parameters around loss given default and probability of default for that risk weight. The net result is that it will bring risk weights up from sort of 50% sort of territory up to the 80-90% territory, which is still less, I might add, than they were under Basel I, where years ago it used to be 100% risk weighting on agriculture. Then when Basel II came in, they dropped down, and it's pretty clear to us and I think to the banks that they dropped down too far, sort of down to around 50% territory, and now we're bringing them up, restoring them back to a more sensible level.
At this stage, can you say what the likelihood is of the Reserve Bank implementing some sort of regulation of loan-to-value ratios in the next few years?
We're not expecting to do anything at the moment. It's an area we'd always keep looking at. We'll certainly monitor developments in lending into the housing market.
Just
Just in light of your remarks in the book Crisis, I wondered what question you were hoping we wouldn't ask and what would the answer be?
Well, it is, Brian, but I mean, I'm sure you know that Swiss proverb that says there's many rivers flow into a lake, but only one flows out. Thank you. Are there any more questions for us? That's for you. You're that very experienced journalist, Barry. Thank you very much, everybody. It's the end of the conference.